Now let's begin explaining DCF valuation. So I'm going to assume that those of you who are listening to this lecture right now does not have any prior knowledge on DCF or the concept of cash flow discount. But it's just going to take around probably 20 to 30 minutes to explain. So for those of you who think that maybe this contents it's too easy, you could go ahead and jump to future sessions. So to understand DCF, I think it's essential to have a very clear grasp of the concept that's called time value of money. While most of you likely already understand the basic idea, so I won't dive too deeply into it, but as a reminder, let's just quickly review this fundamental concept. First, the most basic question. If someone gives me $100,000, is it better to receive it now or should I receive it a year later? Well, this answer is very simple. Of course, it's always better to receive it right now. I think even if you ask an elementary school student, they would naturally say that's their instinct. I mean, they're going to say, give it to me right now. But the second question is going to, make you pause and think. Would you take 100K now or 110K a year later? Now there's a price for waiting. While I'm not completely up to date with the current interest rates, I think receiving 110K a year later, it equates to a 10% return, right? So some of you might think that maybe a 10% return is acceptable. Some of you might think that it's not enough. But personally, as long as there's a guarantee, as long as it's risk-free, in other words, I'd be completely satisfied with the 10% return. So I think it's much more higher than what you would earn if you've invested in a bank or if you invested in real estate. So that said, I would invest it, but that could be different. The decision can be different from person to person. Lastly, let's look at the third scenario where now the price has gone up to 120K, and it's saying that would you take 100K now or 120K a year later? But in this case, now there's some risk. So now we're investing in a biotech startup, and there might be a possibility that the company could fail within a year, which means that you might not get your principal back. So as you can see, from this point onwards, you can see that opinions may vary person to person, and your investment decisions could vary depending on the risk of the asset you're investing in. So to summarize, number one, the value of money always changes over time. So this means that the value of cash today, as we'll later see, the value of future cash flows is higher in the present, and it does diminish over time as we project into the future. And number two, the difference between the present value and the future value of money, it varies depending on the person. So, or in this case, it depends on the investor. Even for the same investment opportunity, some investors might demand a 10% return and some investors might require, in other words, a 15%. Lastly, even for the same investor, the required rate of return can differ depending on the risk of the investment. So naturally, of course, higher investment, higher risk, demands a higher required rate of return, while lower risk, of course, leads to a lowered required return. So now I think you should be able to understand the concept of discounting. So until now, What we usually think about is how much money we're going to get if we invested today. That's generally what people think about in their daily lives. Not only people in, professionals in finance, but just generally we think about you have 100K left over from spending your daily expenses, and what are you going to do with that money? And you project how much you're going to return in a year, in 2 years. You care about the interest, you care about the principal. So usually it's going forward. So whatever you think about, it's going forward. But from now on, the concept of discounting is going to require you to think backwards. So let's say that there's a asset that gives Mr. Potter 100K a year later. And since this is cash to be received in the future, we're going to call it the future value. But anyways, how much value is this 100K worth to Mr. Potter right now at the present? The calculations are relatively simple. So we're going to simply divide the 100K by 10%. Well, technically it should be 1 plus 10%, so technically it should be 1.1. But anyways, discounting it by 10% is going to lead to 90.9K at the present value. So simply put, if Mr. Potter invests 90.9K right now, he's going to get a return of 10%, and a year later he's going to get 100K. So the concept of discounting, as I mentioned earlier, is the same concept of calculating your rate of returns, but with different perspectives. Let's go through two more examples. So very simple. Again, the first example involves a bond with a principal of 100K. And you can see that now there's a scenario where we have 2 years remaining until maturity. So Mr. Potter believes that for a bond like this, he thinks that he should earn a 5% return. So what we're going to do here is we're going to discount the 100K by 1.5 squared. So because it's 2 years, we're doing it twice. And calculating this, you're going to get 90.7K. So assuming no interest rates, the present value of this bond, as seen by Mr. Potter at the present, and assuming he has a required rate of return of 5%, the value that he sees in this bond should be 90.7K. And in the bond market, this price goes up and down real time. And if he sees that this particular bond is being traded at a price higher than this amount, well, he wouldn't invest in it. But if he sees an opportunity where this number is lower, of course, Mr. Potter is going to invest in it because eventually he's going to get a return higher than his required rate of return of 5%. Same logic, it can be applied not just to bonds, but also for real estate properties as well. So let's say there's a commercial property that earns a monthly rent of $1,000. So annual rent is going to be 12K and 12K. And let's assume that we can sell the property at 300K in 2 years. And in this scenario, because real estate is generally considered slightly more riskier than bonds, Mr. Potter's required rate of return is now increased to 10%. So again, discounting. But this time it's not a single stream of cash flows. This time we have 2 streams of cash flows. We're going to start from year 1. So for the cash flow for year 1, we're going to discount it just once. So it's going to be 12K divided by 1.1, which leads us to 10.9K. This is the value of the cash flow for year 1. For year 2, we're dividing 312K, so the total amount, by 1 plus 1 squared because it's 2 years away. So eventually adding these two numbers is going to result in 268K. So the value of this real estate property that Mr. Potter sees is this much. And again, in this scenario, if the value of this property is listed below this price, Mr. Potter is likely to purchase or invest in this amount, and he'll get a return that is higher than 10%, and he'll be very satisfied. So I think, in fact, if you're living in an apartment or a dormitory, you can calculate. You can attempt on calculating the value of the place that you're living in right now, as long as you have your monthly rent numbers, and as long as you can come up with a value of the property in X years. But of course, this is going to be slightly tricky to come up with without background knowledge. But anyways, it's a very straightforward calculation, as you can see. So to sum up, any assets that has cash flows, whether it's a bond or whether it's real estate or even stocks, it can be discounted to the present value, and we can come up with an intrinsic value of that specific asset. I have so much more to say about this topic, but since this is an intro section, I'll stop here and let's move on to our next topic.